Welcome back. Today we're breaking down one of the most misinterpreted economic indicators that directly influences central bank decisions, currency valuations, and equity multiples, the unemployment rate. Here's the uncomfortable truth. The unemployment rate isn't what you think it is. It's not a count of all jobless people. It's not objective. It doesn't capture underemployment, discouraged workers, or people who've given up looking for jobs. And the version your country reports might be completely different from how another country counts it. If you're making macro trades or timing rate cut cycles based on unemployment numbers without understanding what's actually being measured, you're working with incomplete information. What the unemployment rate actually measures? The unemployment rate is technically defined as the percentage of the labor force that is actively looking for work but doesn't have a job. Notice that key word, actively looking. This is where everything gets complicated. The labor force itself is the critical starting point. It's not the total population. It's not even the entire working age population. The labor force includes only people aged 16 and older who are either employed or actively seeking employment. Students not looking for work, not in the labor force. Retirees, not in the labor force. People who've stopped looking for jobs, not in the labor force. This creates an immediate problem for traders. The unemployment rate can fall even when employment actually declines. How? If enough people stop looking for work, they leave the labor force and the denominator shrinks. Fewer unemployed people divided by a smaller labor force can result in a lower unemployment rate, even though fewer people are actually working. The labor force participation rate is what actually captures this. When participation falls while unemployment appears stable or drops, you're seeing people exit the workforce, which is a very different economic signal than genuine job creation. The labor force participation problem. During the 2008-2009 financial crisis, as unemployment spiked to 10%, the labor force participation rate also declined significantly. This masked how severe the actual employment situation was. People weren't just temporarily unemployed, they were abandoning the job search entirely. After the pandemic, the same dynamic played out in reverse. Participation rates remained depressed even as unemployment fell. This told sophisticated traders that the headline unemployment number was overstating labor market strength. There was slack in the system, people on the sidelines who could potentially re-enter if conditions improved. For traders, this matters enormously. A country reporting 4% unemployment with 60% labor force participation tells a very different story than 4% unemployment with 65% participation. The second scenario represents genuine tightness. The first might indicate hidden slack that could support wage moderation even as reported unemployment stays low. Central banks absolutely pay attention to this. When they see falling unemployment but stable or rising participation, that's when they get genuinely concerned about wage inflation and overheating. When they see falling unemployment because participation is cratering, they know the real employment situation is weaker than the headline suggests. Discouraged workers and hidden unemployment. Here's something the headline unemployment rate completely ignores. Discouraged workers. These are people who want jobs but have stopped actively looking because they believe no suitable jobs are available. They're not counted as unemployed because they're not actively seeking employment. The Bureau of Labor Statistics tracks this separately in something called U6, or underemployment rate. This broader measure includes not just the officially unemployed, but also discouraged workers and people working part-time who want full-time work. The U6 is typically 2-3 percentage points higher than the headline unemployment rate. During recessions, this gap widens dramatically. When discouraged workers are abundant, the headline unemployment rate understates labor market weakness significantly. For traders, this matters because it tells you when the job market has genuinely broken down versus when people are just temporarily between jobs. Different countries track this differently. The US provides U6 data. Some European countries provide broader measures. When comparing unemployment across countries, you need to understand whether you're comparing headline rates, or broader underemployment measures. A country reporting 5% unemployment might be comparable to another country's 7% if their underemployment definitions differ. The underemployment issue. Beyond discouraged workers, there's massive underemployment. Someone working 20 hours a week at a retail job when they want full-time employment is underemployed. They show up as employed in the statistics, but their labor market situation is weak. During economic downturns, underemployment spikes alongside open unemployment. During the initial pandemic recovery, underemployment remained elevated even as headline unemployment fell rapidly. This told traders that labor market slack remained despite what the headlines suggested. For wage growth analysis, critical for inflation trades, underemployment is crucial. If unemployment is low but underemployment is high, workers don't have genuine bargaining power even though unemployment looks tight. Wage growth will remain constrained because there's still labor slack, just not captured in the headline number. Cyclical versus structural unemployment. Cyclical unemployment is temporary. It's people between jobs during normal economic transitions. Structural unemployment is deeper. It reflects skills mismatches, geographic mismatches, or permanent changes in what the economy needs. Traders need to understand this distinction because it affects how central banks respond. High cyclical unemployment during recessions is reversible with economic stimulus. High structural unemployment persists even as the economy improves because workers lack needed skills or are in wrong locations. During the COVID recovery, there was massive debate about whether elevated unemployment was cyclical or structural. If cyclical, aggressive rate hikes weren't needed. If structural, tight monetary policy would cause unnecessary suffering. The answer mattered enormously for positioning. The unemployment rate alone couldn't tell you which was which. The definition problem across countries. Here's where international traders really need to be careful. Different countries define unemployment completely differently. The International Labour Organization provides standardized definitions, but countries often use their own methodologies. The US counts someone as unemployed if they looked for work in the past 4 weeks. Germany requires recent job search activity. Japan defines it differently still. These methodological differences mean that comparing unemployment rates across countries is often comparing apples to oranges. A US unemployment rate of 4% is not directly comparable to a Japanese rate of 2.5% or a German rate of 3.8%. The absolute levels don't tell you whose labor market is actually tighter. You need to understand the underlying definitions, labor force participation rates, and broader underemployment measures in each country. For FX traders basing positions on unemployment differentials, this is critical. The country with the lower headline unemployment rate might actually have looser labor market conditions if you account for participation and underemployment differences. Your relative positioning could be completely wrong if you're just comparing headline numbers. Job quality and duration. The unemployment rate also ignores job quality. Someone forced into part-time minimum wage work after being laid off from a professional position shows as employed, but their economic situation is vastly different. Duration of unemployment matters too. Someone unemployed for 2 weeks is in a different position than someone unemployed for 6 months. Long-term unemployment is much more damaging to individuals and the economy. It often reflects structural problems rather than cyclical weakness. For traders, timing labor market recoveries, duration data matters more than headline unemployment. When average duration of unemployment is rising while unemployment is falling, that's a warning sign. It suggests job quality is deteriorating or the recovery is becoming uneven. The Household versus Establishment Survey. In the US, there are 2 main employment surveys. The Household Survey directly asks people about their employment status. The Establishment Survey asks employers how many people they have on payroll. These sometimes tell different stories. The Household Survey can show job growth while the Establishment Survey shows weakness or vice versa. The discrepancies can persist for months before being reconciled. For traders, this matters because preliminary labor market data from one survey can be contradicted when the other survey comes in. More sophisticated traders know to look at both surveys rather than focusing on just one headline number. The reconciliation between them often reveals whether labor market strength is real or whether one survey is giving a false signal. What this means for your strategy. Never look at the headline unemployment rate alone. Always check labor force participation. If unemployment is falling but participation is cratering, the labor market is weaker than it appears. If unemployment is rising but participation is surging, it might indicate a healthy market absorbing more workers. Look at broader underemployment measures. Compare U3 to U6. When the gap widens, that tells you how much hidden slack exists in the labor market. For wage inflation analysis, underemployment often matters more than headline unemployment. Understand the definitions being used. If you're comparing countries or time periods, you need to know whether you're comparing apples to apples. A labor market comparison based on headline numbers alone will often mislead you. For central bank policy timing, recognize that unemployment is a lagging indicator. When the Fed or ECB starts adjusting policy based on unemployment, they're often looking backward at already stale data. Forward-looking indicators like jobless claims or wage growth often signal turning points before unemployment reflects them. Watch duration and quality metrics alongside the headline rate. Deteriorating job quality or lengthening unemployment spells often precede recessions, even when headline unemployment remains stable. These details give you leading indicators others miss. Most importantly, the unemployment rate is one piece of a much larger labor market puzzle. The traders who understand the full picture, participation, underemployment, duration, quality, and cross-country differences, are the ones consistently positioning ahead of consensus. That's where your edge lives.